Get the full global macro and markets picture with Capital Economics' all-access packages. CE Essential gives you full access to all of our award-winning written analysis, all of our online briefings, and a host of critical data tools. And for deeper engagement with our economist team, our proprietary data, and seamless integration of that data into your workflow, CE Advance is our most complete solution. Go to capitaleconomics.com today to learn more about CE Essential and CE Advance.
It's Friday, 24th of October, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, US sanctions on Russian oil are much higher prices in the offing. But first, Group Chief Economist Neil Shearing joins me to run through the numbers on another week in global macro and markets. Hi, Neil.
Hi, David.
Oh, happy day. We've got some US economic data.
This for one day only.
Day 24 of the shutdown, but those BLS staff, they managed to get them in the office and get that September CPI report out. It felt like there was a bit of concern going into this release because I think maybe markets felt like they've been in the dark for so long. As I say, 24 days of a US government shutdown, so none of that key economic data. But now we've had that report out, and just judging by the moves in markets, I mean, they kind of speak for themselves in terms of what the report was saying, right?
On the one hand, yes, they do speak for themselves insofar as we've had a bit of a run in the bond market, particularly at the short end of the curve, a sense that this gives the Fed a green light to cut next week. I think it would have taken something pretty shocking to have stopped them from cutting next week. But nonetheless, a green light from the Fed, and we're guessing at the time of speaking at least, a bit of a rally in the bond market at the short end because of that. I mean, that being said, you wait 24 days for a piece of economic data. It was pretty boring. CPI a bit softer than the consensus expectations, but that was almost all because of a downside surprise in the owner's equivalent rent component of the CPI basket. So it was a pretty dull release, I have to say, even though it does, as I say, give a green light to the Fed to cut next week.
I mean, you say it was pretty boring, but in the context of the ramp up in tariffs that we've had earlier in the year by the Trump administration, in the context of concerns about what was happening on the services inflation front, it's somewhat relieving, isn't it, at this stage that we are seeing such a soft report?
I'm not so sure, really. If you look at the headline data, we've now have inflation running at 3% year on year. If you look at the components, that's where the real story is. Now, it's normal with inflation data for goods inflation to be running at zero or even in negative territory. That's been the norm for the past 20 years, with the exception of the 2-year inflation shock during the pandemic, when obviously supply chains were suffering from extreme dislocation. We had those big surges in demands and supply shortfalls. So apart from the COVID period, goods prices tend to fall and at worst are flat. However, we're now in a period where goods inflation in the US is running at about 1.5% year on year. I've not had a chance to crank the numbers on the September report that we've just had, but if you look at things like apparel prices, they're up 0.7% on the month. So there's some evidence here, I think, that there is some goods inflation coming through because of tariffs. It's just that it's happening alongside that drop in owner's equivalent rent inflation. So we now have services inflation coming down as a result as well. So we are seeing a pickup in goods inflation. It's not right to say that there's no evidence of tariffs on inflation. It's just that it happens to be coming alongside a slowdown in inflation in other parts of the CPI basket. And of course, a sense of scale is important here too. We never thought that inflation would increase by much more than 0.5% to 1% as a result of these tariffs. And of course, we've now got inflation running at 3% or so versus a target of 2%. So it was never likely to be the case that we were going back to the 2022-23 rates of really, really high goods inflation and overall CPI inflation. So bit of perspective, look at the components within the basket, and there is some evidence of tariff-led inflation. It's just it was never going to be as big, I think, as some people had assumed. And the impact on the overall inflation number being masked by a slowdown in some parts of the services basket.
Okay, we get a cut from the Fed next week. Given what you're saying about, bit of caution necessary when approaching this report, does that then mean that the Fed is going to want to be cautious going into the December meeting?
Well, if you look at markets are now close to pricing in almost 100% chance of a 25 basis point cut again in December. So 25 basis point cut at the coming week's FOMC meeting, now fully priced in, and pretty much fully priced in for another 25 basis point cut in December. I'm not so sure that's quite so nailed on. If you look at the economy, the data we're getting on the economy itself, it seems to be holding up pretty well. Not much evidence that the labour market's unravelling. If you look at jobless claims numbers, they're remaining relatively well anchored. So the data that we do have are not pointing to a collapse in economic activity. So I'm not convinced that another 25 basis point cut is absolutely nailed on for December. No, I'm saying all that in the absence of much economic data. We're speaking just before the release of the PMIs, if particularly weak, then and that sustains a run of weak PMI readings. And in the absence of other data, that might start to shift thinking on the FOMC and make another December cut a lock. But at this stage, I don't think it's quite the slam dunk that markets are pricing in.
I mean, the Fed is the most important central bank decision in the coming week, but it is a packed schedule of central bank decisions due. We've got Bank of Canada, Bank of Japan, and then on Thursday, the ECB. Anything from all of those jump out at you that investors should be watching for?
I think a bit like the US CPI data, it might be quite boring, to be honest. I think the ECB is saying it's in a good place for now. I suspect it will continue to believe it's in a good place for now, keep rates unchanged at 2%. We, of course, are forecasting more rate cuts next year, but that's really a story for next year rather than for this year. So a pretty dull ECB meeting, I suspect. Potentially a bit more interesting in Japan. Obviously, we've had a new government, a new prime minister in Japan. Looks like we're going to be having some fiscal relaxation coming too. At the same time, the new prime minister has in the past signalled preference for looser monetary policy. So that might weigh on the BOJ's decision. Of course, the BOJ in a different place to other central banks, tightening policy rather than loosening policy. Our judgment is that on balance, despite the dovish monetary policy views of the new prime minister, actually the fact that the government's likely to push through a fiscal loosening adds to reasons to think that monetary policy might be tightened a bit more than others expect next year. But again, that's a story for next year. So no rate hikes in Japan at the next meeting, but more coming in 2026 and into 2027.
Possibly the big event for the coming week isn't central bank related at all. The White House yesterday was confirming that Donald Trump and Xi Jinping will meet in South Korea on Thursday morning. If it does go ahead, this is going to be the first face-to-face meeting that they've had of Trump's second term. I think it's fair to say it is hotly anticipated, but it's also fair to say expectations that everything in the bilateral relationship is going to come from here are going to be disappointed, right?
I think one point to make is that I don't think either side would be agreeing to this meeting if it were the case that there was going to be no deliverables, or indeed in the absence of a firm commitments and deliverables, there wouldn't be warm words from both leaders in terms of ensuring that there will be some commitments and a breakthrough and a deal in the near future. So I think the fact it's going ahead suggests there might be something on the table. I think that the real question really for markets, for investors, is to look through the headline announcements and towards the substance. And we've argued for a while, in fact, we discussed on this podcast, haven't we, how on balance is probably more likely than not that there will be another kind of phase 2 deal, if you like, between Xi and Trump. We had that phase 1 deal in the first Trump administration. But of course, the phase 1 deal that we had in the first administration, China got nowhere close to meeting its commitments, for example, on imports from the US, buying more soybeans and so on and so forth from US farmers. So again, don't concentrate on the headlines, look at the detail, look at the substance, and then look at China's actions afterwards, particularly China's actions and its commitments to, for example, step up purchases of US goods, because I suspect we'll see something similar, which is to say China fall a bit short of its commitments. And I think whatever happens, developments over the past couple of weeks or so, the spat over rare earths, the spat over the expansion of the US entity list, and of course, the fact that for some time over the past month, it was even in doubt as to whether this meeting would happen, suggests that there's not going to be a fundamental reset, I don't think, of the US-China relationship as a result.
Yeah, I mean, at the heart of all of this has been these rare earth regulations. The timeline is that the US expanded its entity list in late September, and that annoyed China because there'd been an agreement that there wouldn't be that kind of move while talks were ongoing. And then China announces these rare earth regulations earlier this month. We discussed those at length last week, but we didn't really have time to get into the sort of extraterritorial aspect of these rules. This idea that China intends to impose license requirements for companies using its rare earths, even for goods made outside of China. And it feels like there's lots of echoes here with what the US has done in terms of restricting access to semiconductors. And if you put it all together, you can see how you've got these twin poles of the global economy, both basically claiming jurisdiction over supply chains. So I wanted to ask where you think this all ends. What are the implications within this framework of global fracturing for the idea that we can have the sort of smooth flow of global goods trade when you've got economies, we got the US on one side and China on the other side, bearing down on supply chains with basically legal constraints like these?
I think if you take a step back from the fight over rare earths specifically, I think you're right that a key development, if you like, over the last few months has been the extraterritorial nature of some of these restrictions. During the Biden administration, we got used to the idea that the US would cajole its allies into imposing restrictions on the exports of high-tech goods to China. We saw that most obviously with semiconductors, but not just semiconductors, but the technology that's used to produce semiconductors. So ASML, the big Dutch producer of lithography machines that are used to produce semiconductors, also essentially being coerced into imposing controls on exports to China too. This time, we're seeing China try to mimic that coercion on others with its own restrictions on rare earths. So you mentioned the extraterritorial nature of these restrictions. So it's not just the restrictions on China's exports of rare earths themselves, but also curbs on goods, a certain proportion of which the Chinese rare earths are used in. So I think this marks a bit of a departure from the kind of trade war 1.0, if you like, where the US has put in tariffs on China and China is potentially responding with restrictions on its own. So now we're in a world where both sides are trying to either coerce allies into putting restrictions on the other one, but also not just placing curbs on their exports from their own countries, but also from controlling goods that have a certain amount of either American technology or, in this case, Chinese rare earths. Now, the question is, to what extent does this mark a permanent departure, or and it's the thin end of a long wedge? I think nobody really knows. But it wouldn't surprise me to see that the trade war develop along these lines, away from tariffs and goods into more areas to do with technology, strategic dependencies, and to see both sides put pressure on their respective allies. That, if you like, is the essence of this fractured world that we've talked about so much.
How is this not a negative for the global economic outlook?
Well, it is a negative for the global economic outlook, but I think it really depends on the extent to which these restrictions both stay in place but are either ratcheted up, expanded to cover other areas, and are kept in place for a long period of time. Now, at the moment, China's curbs on rare earth exports have not fundamentally affected the flow of rare earths around the world. We've restricted access to those, particularly in a refined form. So they're not having this really disruptive effect through global supply chains that they could potentially have as we speak, which is not to say that that couldn't happen if the restrictions were tightened or indeed they were kept in place for a long period of time. So it's partly the absence of disruption so far is partly because the restrictions themselves are not particularly tight. They've not been kept in place for a long period of time so far. Companies can find ways around them or use inventory to cushion the effect of the curbs. But if they're widened, if they're taken beyond Chinese rare earths and China takes them into other areas, it has, for example, a stranglehold not just on rare earths but global supply of batteries and battery technology, then we could start to see much greater disruption. And as I say, the length of time that these restrictions stay in place, as well as just how strict they are, matter too. So the fact that we've not seen any disruption so far does not mean that we won't see disruption going forward. Equally, if we get some kind of breakthrough next week, both sides agree to kind of step back and dial down restrictions on one another, then the world economy will move on, and there won't be much impact here. So a lot hinges, in that sense, quite a lot hinges on the outcome for next week.
But we're not going back to 2017 pre-Trump, pre-trade.
No, I think it's difficult to put this genie back in the bottle. And I think in that sense, China's response to the Trump administration's decision to allow NVIDIA to sell some of its more advanced chips to Beijing is instructive. Right? Beijing basically turned around and said, thanks very much, but we're not interested. We want to develop our own domestic sources of semiconductors because we don't want the strategic dependency on the US. Extremely worried about that. In fact, we got more evidence of that in a gathering of senior leaders in Beijing over the past week, sketching out the priorities for the next 5-year plan due in March of next year, where the second overriding objective was to develop greater self-sufficiency in areas of advanced technology. So this is not going away, even if both sides can manage to row back from the brink at the meeting next week.
Neil Shearing there on fracturing and supply chains, on US-China relations, and on a very busy week in central banking. We have a drop-in, that's one of our short-form online briefings, on Thursday at 11 o'clock New York, 3 o'clock London, to review decisions from the Fed, from the ECB and others, but also to preview the Bank of England meeting that's happening the following week. Registration details for that session will be in the podcast notes. On China, I'll also share a note that speaks back to what Neil was saying there about other areas that Chinese export controls could target. That note was out in January, and it's a useful framework for thinking through what could follow these rare earth rules. We are tracking US-China developments closely, from ongoing bilateral talks on the sidelines of the ASEAN meeting in Malaysia to that expected face-to-face at APEC later next week, and we will be covering all of it in our written analysis. We will review what we've learned on the podcast next week, and we'll have a drop-in as well if there is something consequential out of all of this. As always, if you want to talk US-China directly with the team, or anything on the macro markets front, in fact, then do get in touch and we can set up a meeting with one of our economists. And if you're not yet a subscriber to Capital Economics and want to learn more, contact us at sales@capitaleconomics.com and we can quickly set you up with access. I also want to flag that on Monday, our emerging markets team will be doing a drop-in in the aftermath of Argentina's crunch legislative elections. These are seen as a referendum on Javier Milei's reform program, and according to Donald Trump, ongoing US support for Argentina's economy is contingent on his coalition winning. The team will get into the results and their implications in a briefing at 8 a.m. New York, 12 o'clock London. That is this coming Monday. Now, for some time, our commodities team has been forecasting that Brent crude prices would fall to $50 a barrel on the back of too much supply and not enough demand. One of the key risks to that view has always been that Russian supply would be disrupted by some kind of punitive action in relation to Vladimir Putin's failure to move to end the war in Ukraine. That risk became a reality this week with the Treasury Department announcement of sanctions on Rosneft and Lukoil, Russia's two biggest players. Oil prices spiked in response. But does this signal a fundamental shift in the market outlook? To find out, I spoke to David Oxley, our Chief Climate and Commodities Economist, and I started by asking about the significance of the Treasury announcement.
Well, potentially very significant. Just to put some numbers on it, Rosneft, one of the companies that has been sanctioned in this package, accounts for around half of Russia's oil production. And Rosneft and Lukoil together account for around 5% of global oil output. So we're really talking about major players big enough to move the needle at a global level. So I think it's potentially very, very significant. The question is, as ever, the devil's in the detail, really, of what the actual lasting impact of these sanctions will be. I mean, there is a question as to whether they will even see the light of day. They're not actually due to come in for another month or so, towards the end of November. It could be that these are really trying to force some concessions or some perceived concessions out of Putin, and they don't ever see the light of day. If they do come in, then there's a broader question of how long do they stay in? How effective are they in terms of targeting sort of secondary sanctions down the supply chain? But also, how strongly are they enforced? That's one thing we've seen with sanctions against Iranian oil, is that a lot of the oil flows have just adjusted and really worked around. So again, there's lots of question marks. It's potentially a big deal. But at this stage, there's more questions than answers. I think that really explains the reaction in the oil market. We saw oil prices rise significantly by around 5% after the announcement of the day following, as traders have kind of mulled what the impacts on Russian exports on the global oil market will be. But for what it's worth, we're recording this on Friday morning in the UK. Brent crude is broadly flat, just below $66 per barrel. So it's not ratcheting up. I think we're kind of in a bit of a wait and see mode to just see if these announced sanctions see the light of day, and if they do, how effective they are.
So that 5% move we saw on Thursday, it's almost like the oil market has been put on notice that this is a risk. It's a risk certainly that your team has been flagging for months now. Just talking about whether or not they actually come in, because Trump's relationship with Putin, I mean, it's an interesting one to say the least. But the general sense is that he doesn't have the appetite to go ahead with these sorts of sanctions. If we get to that deadline and, he backs down or the situation changes, do we see prices coming right back off, or is this now a risk that's priced into the market?
It's hard to say with certainty, but I think if it did become clear that this was posturing to get Putin to concede, if things go Trump's way and he does back away, my hunch is that the oil market participants will then rapidly turn their attention back to the fundamentals in the market, which, as we've been warning for a long time, are fundamentally quite bearish. Coming into this, before this all erupted, all of the story in global oil markets in recent weeks has been on as we've been warning for a long time, the potential for quite a significant glut to open up next year and to bear down on oil prices. As OPEC have been bringing more oil back to the market this year, the demand backdrop next year doesn't look particularly strong. Oil prices were falling to lowest levels in 2021 before this. So I think that is an important bit of context needed here. We've had a 5% jump in oil prices, albeit from $60 per barrel. This isn't a huge shock as yet.
Let's imagine that Trump does go ahead with the sanctions. Let's imagine that they do prove somewhat effective, that secondary sanctions kick in, that you get Indian and Chinese buyers stopping their purchases. What's the worst case outlook here for the oil price?
We put a note out yesterday exploring this worst case outlook. It's hard to say anything with any degree of certainty, but if you look at Russia's total seaborne exports, which I think are around about 3 million barrels a day, maybe a bit more, if you were to lose all of that, these are significant numbers for the global oil market. And crucially, if you were to lose that supply from the market, whereas 9 months ago, you would have sat here and been like, actually, the rest of OPEC Plus has sitting on quite a lot of spare capacity that they could potentially bring back to the market to help to offset that. That is still true. I think Saudi Arabia and UAE still got some oil up their sleeves that they could bring back to cushion the blow and to increase their market share if there was to be a significant Russia-related tightening in the oil market. I don't think that will be enough. So in a worst-case scenario, this could potentially be the difference between what's now pretty widely regarded as quite a significant surplus opening up in the oil market next year, potentially actually a small deficit, which in a worst-case scenario, you could easily see $80 to $100 oil. So I think that is why this is really up the ante.
And what about the secondary sanction issue? Because Trump's been trying to get India in particular to stop buying Russian oil for months. Latest reports suggest that Indian and Chinese buyers have at least paused their purchases. How significant is that? Does this mark a shift in their buying behavior, or are they in wait and see mode like the rest of the market?
At this stage, I think it's probably more the latter. You really don't want to poke the bear with President Trump. I can see this as being a sort of just waiting to see how this pans out. One thing they might be waiting to see what happens is, yeah, as you said earlier, is Donald Trump's heart really in this? And I think we've had a few clues there from Trump. There's certainly the sentiment, I think it was in the Truth Social message about how he hopes the sanctions won't be in for long. But of course, as well, I mean, Donald Trump has made absolutely no secret of his desire for low gasoline prices. So is he really going to completely go full board down a chain of events that would clearly push up gasoline prices? So I think that is one thing if we are in wait and see mode, to wait and see about.
Okay, terrific uncertainty out there. Lots of moving parts, lots of personalities at play that are unpredictable to say the least. Put it all together with regard to also what you've said about just the fundamentals of the oil market. What are you telling clients in terms of where prices are going through the end of this year and into 2026?
Well, at this stage, we don't really feel the need to change our forecast. So at the minute, because it's not clear if the fundamental picture is going to change at this stage. We are sticking to our view that there will be a substantial glut open up in the oil market next year. We're sticking to our view for Brent crude that the price will fall to $50 per barrel by the end of next year, which is well below consensus. But just like everyone else, we are in wait and see mode, because this isn't something necessarily that would just move a risk premium. This could potentially, as I said earlier, mark a big change in the actual fundamentals. We reserve the right to change a forecast if the fundamental picture changes. But at this stage, huge amount of uncertainty. We don't feel like we're in that position just yet.
That was David Oxley on an uncertain oil market picture. I will add the team's response to the sanctions announcement to the podcast notes. But that's it for this week. We will be back next week with more from the front lines of global macro and markets. Until then, goodbye.